about multifamily versus single family investing and which one is actually better. So obviously, which one is better is going to depend on you and your personal financial situation, what your goals are, what your experience level is, what your personal relationships are, and all of your resources that you can deploy, and also how much time you have to invest in single family versus multifamily assets. So my name is Mathew Owens. I'm a California licensed CPA. I've flipped over 1,000 houses now. We have over 35 million lent out to flippers in different markets around the country. We do a lot of value add multifamilies. We invest actively and passively in syndications. We invest tons in multifamily as well as single family. So we understand this space very well. And in this video, I'm going to take you through the pros and cons associated with both single family investing and multifamily investing so that you guys can determine what's right for you and your own personal financial situation and which strategy you want to try to deploy for yourself and creating financial freedom in your life. So let's get into it. The very first thing we're going to talk about is the pros and cons on single family home investing. So obviously, a lot of investors start out with the single family space because it's a lot less scary to them, right? It's a simpler type transaction. They have less capital that they need to start off with on a single family versus a larger multifamily project. So they tend to push towards that single family strategy because there's less capital infusion. There's less complex systems to be able to get your head wrapped around when you're learning real estate. So you have a lot of new investors shifting towards the single family space, regardless of the pros and cons of both strategies. And so, for example, in a single family home, you have one set of systems, one roof, one electrical system, one plumbing system, one HVAC system, one set of appliances, one water heater. So it becomes a lot simpler to understand the inner workings of the renovation when you're dealing with single family versus multifamily, where you might have 50 HVAC systems and 50 water heaters and 50 sets of appliances, multiple roofs on multiple buildings. You have exterior work where you have, staircases and things like that, a lot of big landscaping issues and things like that that could come up. So it's a little more complex, and people tend to move towards the single family space. They get their head wrapped around real estate first when they first get started. Okay, so one set of systems, a little bit less scary in single family homes, and the less capital to get started with versus maybe a bigger down payment on a multifamily type property. Also, I personally think that the financing is better on single family homes versus the multifamily space. Typically, in the single family space, you're going to be able to get a 30-year fixed rate loan on that property. You're going to come with a little bit less down payment. Maybe it's 20 to 25% down on single family versus maybe 25 to 35 to 40% plus down on a multifamily, depending on the debt service coverage ratio on that multifamily, basically, which means that the lender needs to make sure that after you pay your debt, you still are left over with cash flow and you're making money every single month to make sure that you aren't going to default on that deal. And if they have a major vacancy or a drop in rents, then that lender is going to be taken care of. So they finance you based on the debt service coverage ratio a lot more versus personal qualifications on the single family space. Now, at the same time, there is debt service coverage ratio loans associated with real estate. Well, they'll lend right to your LLCs as well. But I really like the financing on single families because you get that 30-year fixed, you're locked in, you don't have to go refinance. And, typically multifamily is going to be 5, 10, 15-year max type terms. Usually 5 and 7 and 10 is what we see out there on the multifamily space. In addition to that, in the multifamily, you are going to have maybe a 20-year or 25-year amortization period. Even if there's a balloon in 5 or 7 or 10 years, you're going to have a faster amortization. So it increases your payment a little bit comparatively to a 30-year fixed rate loan on single family. Okay. So in addition to that, in single family, it's a little bit harder to scale, right? You got one house that you can purchase and be able to, maybe you're going to get a couple $100 a month in cash flow on that specific asset versus maybe a couple thousand or a lot more in multifamily, depending on how many units you actually buy. Now, multifamily is classified as 5+ units. I think once you get 20, 30, 40+ units or more, it starts to become really scalable at that point, where you can really increase your cash flow and cover your monthly expenses so you can retire off of that, versus single family that might get you a couple $100 a month in cash flow. In addition to that, you have to constantly be grinding to find more single family homes over and over and over again, so you can keep that going and start to scale at that point, which is a lot harder to do in multiple projects, multiple locations, and now you got multiple systems, very similar to multifamily, right? So except multifamily is in one building versus a lot of buildings over here in multiple areas and multiple markets and multiple management companies, multiple contractors, multiple teams. It becomes very difficult to manage that process over and over again. And trust me, I know I've flipped over 1,000 of these houses. I know what it takes to build this on a scaled type approach. Okay. So it's a little bit more difficult to scale on single family versus the multifamily space. Okay. So if you think about it, there's the same level of work on a single family versus multifamily. Would you like to do a same set of work on one single family home that gets you a couple $100 a month or gets you that flip profits versus a multifamily that maybe you're dealing with 50+ units across the board on a project, you know? So all of those things should be taken into consideration when you're determining which strategy you want to deploy. Is the work level difference there? Okay. We've also found that contractors and managers in your team are a little less sophisticated in the single family space. You can find very sophisticated people in that space that can work with you really well. It just takes a little bit more effort to find them, versus the multifamily space. You usually have a higher level of contractor that's licensed and bonded, for example, versus maybe a smaller contractor in the single family space. There's a lot of unlicensed people that will do your renovation on your single family, versus the multifamily on a much bigger project. A lot of them are licensed and bonded in that case. Same thing with the property managers. Maybe they have a higher level software. They're better at the collections on scale. They're better at the service calls on scale, versus single family. That manager's got to go to all these different projects for service calls, versus one property over and over again that might have an on-site manager as well to be able to manage that portfolio, that property a little bit more efficiently, where you can take some of the workload off the initial property manager and have an on-site manager in place. Okay. So, key things to understand when you're dealing with your teams in these different markets. Okay. Now, flipping can be great on a single family and much faster than flipping a multifamily. You can buy it, renovate it, tenant it, resell it right away for a single family type asset and get your money back very quickly. But if you're flipping multifamily, you're going to buy it. You're going to renovate it over a period of time, because you're not going to go through and renovate a 100-unit building all in year one. That might take 3 years to get done, or 2 years to get done to renovate all of the units. Then you need to show the new cash flow stream for at least 3 to 6 months, so that that lender, for the buyer, knows what the new cash flow is and qualifies that buyer based on the new cash flow that's in place, not the old cash flow that you already had previously from before you did your value add type structure. Okay. So obviously it's a slower process to sell a multifamily type asset when you're dealing with a major value add play, because you have to show that performance long term. Okay. So there's usually a little bit more volatility in rents on a single family versus multifamily, because you have one tenant. So if they lose their job, they stop paying you, there's a major repair or something like that that occurs, you have a vacancy, then you lose 100% of your revenue, versus in a multifamily where you have multiple tenants. Then you have a little bit of diversification of tenant base there, to where if that tenant one tenant doesn't pay you, or a few tenants don't pay you, or you have a couple repairs, you still have the ability to pay your loan, to pay your monthly expenses. You just are reducing some of your profitability due to that inefficiency on that side. So you still have income coming in to pay your bills versus no income over here to pay your bills. And so you need a reserve. You should have reserves for both strategies, but the reserve for the single family, you're going to be diving into a lot deeper when you have a vacancy, or repair, or major repair, or a tenant turnover type issue that occurs. Okay. So there's a little bit more volatility in that cash flow on a single family versus a diversified tenant portfolio with a multifamily. Okay. So, and then there's typically more marketing required on the single family space than the multifamily space, because you're constantly grinding to find that next deal and that next deal, so you can scale up and get that $200 single cash flow property up to multiple, maybe 10, 20, 30 of those things, to be able to scale those things at the same level as a multifamily. And so you're constantly marketing and marketing and marketing. You definitely market on the multifamily space too, and you're consistently doing that, but you might have one big project, take it down, do operations, and then start marketing up again on your next acquisition cycle. And then the single family, you're nonstop marketing to get deal flow in all the time. Okay. So those are some of the pros and the cons associated with single family investing. Let's talk a little bit about multifamily investing and some of the pros and the cons there, right? So like I mentioned, it's much easier to scale and hit that financial freedom goal of covering all of your monthly expenses with cash flow from a multifamily asset versus a single family asset, right? So, and like I mentioned, there's a higher level of team members there when you're dealing with multifamily versus single family, with more institutional level team members from contractors and managers and all your teams involved. The ability to put secondary asset management in place. Normally on a single family, you have the property manager that manages all these individual houses, and you are managing that manager for any problems, making decisions, saying, I want to do that to this project, I want to do that to this project, running your math on your efficiencies, making sure that the manager is efficient. In a multifamily, typically the structure is you have a property manager, you have an on-site manager, and then you have an asset manager that manages both of them combined, so that you as the private investor don't necessarily have to do that. You actually have an asset manager that can be put in place, that because of that scaling, so the profitability of the multifamily can typically support an asset manager in place that can go through and manage those managers effectively. And they are typically the professionals that know how proper asset management works. Now, not always, because there are some really bad asset managers and some really bad operators out there. And so dialing that in is very key, and knowing what makes a proficient and inefficient asset manager and property manager is key to that success. Okay. So in addition to that, more management, the more units means there's more management of the major systems, right? You have to have proper CapEx put aside, capital expenditures for the future put aside for when that water heater breaks, or that plumbing and electrical goes out, or that roof goes out. You got to put money aside every single month for those things, so that when the useful lives of those assets are up, then you have the reserves sitting there to do that. And you're going to do that on scale. And so tracking that can be a little bit of a headache, right? You have categories. I have X amount of roofs, X amount of plumbing and electrical and HVAC systems that you need to be allocating every single month for replacement, so that you have an even cash flow. This is where a lot of mom and pops get into trouble, where they actually go through and forget about CapEx. They are cash flowing great for years, and then all of a sudden they have $100,000+ worth of renovation costs that they got to go put into a project, and they think this property's not working, I'm not making any cash flow, because they didn't put aside the proper CapEx on that deal consistently throughout the years and pull it out of the good years cash flow to make sure they have reserves there, so they have an even cash flow stream associated with those assets. Okay, so you have some more collections, service calls, evictions, and problems with tenants, just because you have more tenants tenants to deal with in a multifamily asset versus a single family property. Now you have the manager, the on-site manager, and the asset manager in place that will hopefully solve those problems for you, so you don't have to be the one doing all that work involved. Okay. So now I also mentioned that the financing matters, and we have a 5, 7, 10-year type term typically on the multifamily, with a 25-year amortization versus a 30-year amortization. And also understanding in a multifamily, the culture of the tenant base in your multifamily building actually matters. You have to have a positive, good culture where your tenants are happy, because they will talk to each other, and you will get mutiny on your hands in a multifamily if you don't actually get a handle for the happiness of your tenants. Have a great tenant retention program in place so that you can be successful at this long term and have a good, happy, functioning tenant base in place. Okay. So in a multifamily, it's actually easier to force appreciation of an asset. In a single family, you have your purchase, renovation, and you know what your end value is. That's great. You can force appreciation that way by doing the renovation of that property and getting top dollar for that property. And it's more governed by the other sales in the market, right? The other sales that the appraiser is seeing on the market. In a multifamily, you are valued based on the cash flow of that asset, the net income. So there's ways to reduce expenses, maybe pushing utilities on tenants, disputing property taxes, looking at the inefficiencies of the old owner and taking out some of their personal expenses that they threw in there. There's a lot of little ways of reducing those expenses, reducing your vacancy and your collections problems and things like that in place. You can reduce your tenant turnover, all those expense reduction strategies. On the other side, you can also increase revenue by increasing to market rents, by going through and adding pet fees and other costs involved, that you can increase your revenue. So and the multifamily is valued, like I mentioned, based on cash flow. So if you increase rents, decrease expenses, your cash flow increases, and therefore the value of your building increases also, so that you can force that appreciation a lot easier in a multifamily type property. And especially when you're talking about scale, if you have 100 units that gets $100 an increase in rents, that's a massive increase in value just by increasing the rents across the board to market rents. Okay. So you can get larger chunks of equity increase from doing these value add strategies versus a single family. You might make $50,000 on a single family home flip, but if you take a 50 or 100 unit building and increase revenue by $100 a unit, you might get a $600,000 or $1 million equity increase by utilizing that strategy and increasing your rent. So much bigger bang for your buck in the multifamily space on the value add strategy, especially if it's near the same level of work, because you have a manager in place, an on-site manager, an asset manager in place that is helping you deploy that strategy specifically. Okay. So now you might need a little bit more experience to buy a multifamily building and get the financing for it. Usually the lender's saying, well, let me look at their financial strength. Are they going to be able to pay this debt if something goes wrong? Are they financially stable? Otherwise, you might need a financing partner to come in that does have that financial stability. They also want to look and say, do they have experience managing multifamily buildings? Who's their property manager on the ground that's going to help them with that? What's their experience? They're going to be looking at the experience aspect of things. If you're a brand new investor trying to buy a 100-unit building with very little net worth, maybe you have the down payment, but you have nothing else or very little for reserves, they're going to be looking at that with a fine-tooth comb to make sure that you have the ability to repay this type of financing. So you want to make sure that you have the right experience, the right reserves, you're financeable. In a multifamily versus a single family is a little bit easier to obtain that financing. Okay. Now in a multifamily too, you don't have to do all this work. You can invest as a limited partner in a general partner's deals, in someone else's deals. So you can go in and say, hey, I'll go put in $25,000, $50,000 and into a multifamily where the total capital requirement might be 500 or a million or $5 million. And so you're a smaller investor and you can diversify into a lot of these different multifamilies with different markets of the country and different operators as well, and put in a smaller amount of money. And then you don't have to qualify for the financing either. That general partner or that operator does that on your behalf, and you are the limited partner. You're giving up control to them because they are the professionals at doing this and know what they're doing. But you have diversification and you don't have to do any of that work yourself. You don't have to qualify for the financing yourself. And so there's a lot of pros where you can invest passively in multifamily projects and don't have to be the active operator involved. You can be, but you don't have to be in a lot of these different projects to get that benefit. Now, in the multifamily side, there's also massive tax benefits, especially if you're doing a cost segregation study and front loading those tax benefits into year one. You can do the same thing on a single family, but it's usually a much smaller bang for your buck on the total depreciation benefit versus over here in a multifamily where you can get massive tax deductions because it's based on your purchase price of the building, especially if you're leveraging that building. Comparatively, the tax deduction compared to the investment amount that you're putting in can be huge as well. I do this every single year where I get big tax deductions just by investing in more multifamily properties over and over and over again. Okay. So in addition to that, a lot of people think, oh man, I need to flip properties because I need that actual cash infusion over and over again. You don't necessarily need that. If you want to focus on multifamilies, there are typically acquisition fees that you can have put in there as well to make sure you can keep the lights on and make sure you have enough financial stability to run that property. There's also asset under management fees as well that get built in to help you pay for the labor associated with managing that property long term. And then there's a split with the investors where you have incentive for performance with preferred returns involved and things like that. But you can keep the lights on through acquisition fees, through assets under management fees, and things like that. You don't have to flip to keep those lights on. So I hope this video helped you guys understand a little bit more about the pros and the cons of both single family and multifamily investing. Obviously, multifamily for me is the way to go. And even after flipping 1,000 houses, I can tell you that multifamily is a more efficient strategy in my eyes than the single family home type flipping. So if you guys like this content, please like, subscribe, hit that notification bell, and we will update you on all the tips and tricks about real estate investing to take you guys to that next level and help you guys create financial freedom in your life through real estate. Thanks so much, and I hope you guys have a great rest of the day. Talk to you soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.